Welcome to the Deep Dive. We're here to take that stack of financial documents you've got, cut right through the jargon, and really pull out the core story, give you the context, the aha moments, quickly.
And today, we are digging into eClerx's Services Ltd. We're looking at their unaudited, consolidated results for Q2 and the first half of fiscal year 2026. So that's the period ending September 30th, 2025.
Right. You share the earnings presentation, the press release, and our job here really is to figure out the strategy behind these numbers. They look pretty good on the surface.
Yeah.
What did management actually achieve this quarter? And maybe more interesting, what are these financial moves telling us about where they think things are headed?
Well, straight away, if you look through the material you sent over, two things really jump out, big headlines. First, the profitability, just wow. Net profit surged 30.6% year over year. That's INR 183.2 crore. That suggests since they're running, very smoothly operationally.
Yeah, that's a serious jump. And the second headline, it feels like a big statement from the board, doesn't it? This massive share buyback.
Exactly. It's not a small amount. We're talking INR 300 crores worth of equity shares. And look at the price Rs, 4,500 per share through a tender offer.
Right. When management puts that kind of capital back into its own stock at that kind of price, they're definitely sending a message about how they value the company.
Absolutely. And just for context, remember eClerx's is a specialist services firm. They handle complex, data-heavy processes for big global companies, sort of the critical back-office engine.
So they're supposed to be an efficiency engine for clients.
Yes. And this quarter, it looks like they seriously tuned up their own engine.
Okay, so let's start at the top. Revenue. Where did the growth come from? Was it, broad-based or just a couple of big wins?
Overall, the momentum on the top line looks really robust. Total revenue, and this includes other income, hit INR 1,035.2 crore in Q2. That's up a strong 22.6% compared to last year.
And if we strip out that other income and just look at the core operating revenue,
Still very solid. That came in at INR 1,004.9 crore, so up 20.8% year over year in rupee terms.
okay. And for a global business like this, we usually look at USD terms too, right?
Thank you.
Constant currency.
Exactly. In US dollars, that operating revenue was $115.5 million, which is a 16.9% increase. But the constant currency figure, which kind of strips out the tailwind from the exchange rate, is key.
And what was that?
Q2 year-over-year CC growth was 16.3%, a very healthy number. But what's maybe even more telling is the momentum within the year. Quarter-over-quarter CC growth was 5.4%.
Ah, so it's not just better than last year, it actually accelerated from Q1.
Precisely. That shows things are picking up speed right now.
And this isn't just a one-off quarter, is it? I think you mentioned their longer-term track record.
That's right. If you look back, their four-year revenue CAGR from fiscal 21 to 25 was 16.6%. So they have a history of consistent expansion. This quarter fits that pattern, maybe even strengthens it.
Okay, but where is the growth coming from now? That sequential growth of 5.4% you mentioned, is it the big established clients or are they winning new business?
That's actually a really interesting part of the story. If you break down the Q-on-Q growth, you see a difference between their strategic clients, that's the top 10, and their emerging clients, the ones spending over $500,000.
Okay, so the top 10, the big anchors.
Revenue there grew 15.4% quarter on quarter, which is good, solid growth from your base.
What?
But look at the emerging segment. Revenue growth there, 27.2% sequentially.
Wow, okay, that's way higher, almost double the growth rate of the top clients.
Exactly. Growing your biggest clients by 15% in a quarter is already pretty good going in this industry. But seeing that next tier, the emerging ones, accelerate that much faster.
It tells you the sales team is really clicking, right? They're bringing in new logos or significantly expanding those mid-tier relationships. It feels like diversification in action.
It really does. It suggests they're getting better at taking their specialized services and applying them to a wider set of clients. It's a really positive sign for de-risking the business model.
Oh, well, they're still pretty concentrated at the top, aren't they?
Oh, absolutely. Need to keep that in perspective. The top 10 clients still make up 63% of total revenue, so they rely heavily on those big accounts.
But that accelerating growth in the emerging group is exactly what you'd want to see to gradually reduce that concentration risk over time.
Precisely. It's the ideal trend.
Okay, so the revenue story is strong, maybe even accelerating and broadening out a bit. But often, high growth comes with higher costs, especially in services. But you hinted the real story was lower down the P&L.
Yes, this is where things get really impressive. The margin expansion this quarter is exceptional. It's the key story, I think. Let's look at the sequential numbers, Q2 versus Q1.
Okay, hit me with the big ones. EBITDA.
EBITDA reached INR 2,983 million. Sequentially, quarter on quarter, that's up a massive 27.1%.
Whoa, okay, wait. Operating revenue was up 5.4% sequentially in constant currency, you said, but EBITDA jumped over 27%.
Exactly. That immediately tells you something fundamental shifted in their operations. Huge leverage.
And net profit, same kind of story.
Yeah. Followed right along. Hit INR 1,832 million. That's a 29.3% jump compared to Q1. This isn't just revenue growth flowing through. This is serious margin improvement.
Let's put some numbers on that margin expansion. EBITDA margin itself.
Jumped to 28.8% in Q2. That's up, get this, 399 basis points from Q1.
Wow. Nearly 4 full percentage points of margin improvement in one quarter.
Yeah. For anyone listening who doesn't live and breathe basis points, 4 percentage points improvement in operating profitability in just 3 months. That's pretty rare, especially in a competitive space like IT and BPO services.
So the obvious question is how? Where did they find almost 4 points of extra margin? How did they pull that off?
It looks like operational leverage really kicking in. The biggest cost for any services company is people, right? Their delivery and support employee costs actually dropped slightly as a percentage of operating revenue.
Dropped even with revenue growing.
Yep. Went from 54.7% of operating revenue in Q1 down to 52.5% in Q2.
Okay, so they grew revenue over 20% year on year, but managed to make their single biggest cost item smaller relative to that revenue. That screams efficiency gains. Better pricing, maybe? Better utilization?
Likely a mix of both. And it wasn't the only place they found savings. G&A, general and administrative expenses also ticked down as a percentage of revenue from 9.0% in Q1 to 8.5% in Q2.
So controlling the big people costs, trimming the overheads, all while growing the top line strongly. That's the recipe for that kind of margin pop.
Exactly, and you see it flow right down to the bottom line. Basic earnings per share, EPS, jumped to INR 39.U for the quarter. Compare that to INR 29.7 a year ago. It's a clean earnings story, internal efficiency, using their capacity well.
Which is a perfect lead-in to talking about that capacity, the operations, the workforce, because those margins you just described are directly tied to how they manage their staff.
Absolutely. Let's look at the in-room.
Scale first. Are they still hiring? You'd assume so with that revenue growth.
Oh yeah, still expanding aggressively. Total headcount hit 21,415, and the key number, total delivery headcount, was up 18% year over year, reached 21,293.
Okay, 18% growth in delivery staff. But the key is making them productive quickly, right? Utilization.
Spot on. And they improved there, too. Staff utilization for the delivery folks ticked up quarter on quarter. It was 72.8% in Q1, and it rose to 75.1% in Q2.
Right, that 2.3 percentage point increase in utilization, that's the direct input into those better margins we just talked about, getting more billable work out of the existing and new staff.
It's crucial when your main cost is salaries.
What about keeping staff? Attrition is always a big topic in this sector.
Right. So offshore voluntary attrition, people choosing to leave, came down to 20.3% in Q2. Now, compare that to Q2 last year when it was 28.8%.
Okay, that's a significant drop year over year, down 8.5 percentage points. That looks good on the surface.
It's definitely a positive trend.
But hang on, 20.3%. I mean, that's still 1 in 5 delivery employees leaving voluntarily within the year, right? Even with great financial results. Is that really good or just less bad than it was?
That's a fair point. It suggests the war for talent isn't over. They're still battling retention. But the trend is clearly positive. The sharp decline, plus the fact they still managed to hire 18% more people year on year, it suggests things are stabilizing.
So managing the churn better, even if it's still relatively high.
Exactly. Managing it well enough to drive those fantastic margins, which is key.
Okay, let's shift focus slightly. Geography and currency. Where's the business concentrated?
Well, the currency mix is overwhelmingly US dollar, 86% of revenue. And that ties directly to the geography. North America provided 80% of total revenue this quarter.
80%. Wow. Is that concentration growing?
It is actually. It was 74% just back in Q3 of fiscal 24, so about a year ago. It's crept up significantly.
So while focusing can be good, they are really, really heavily reliant on the U.S. market now. Almost everything depends on North American corporate spending.
It does. Their fortunes are very tightly linked there, which makes the whole currency strategy, which we should get into, even more critical.
Yeah, definitely. Let's talk about the balance sheet health and that forward-looking strategy.
Well, first off, the balance sheet looks rock solid. Reserves and surplus grew 14% just since March, hitting INR 25,772 million. And they are swimming in cash.
Cash position.
Cash equivalents reached INR 12,506 million this quarter. That kind of cash pile is exactly what enables that huge INR 300 core buyback we mentioned at the start.
Makes sense. But before we get deeper into the buyback and hedges, there was that other income spike you mentioned. Q2 was INR 303.9 million, way up from about 105 million in Q1. What was that?
Yeah, good catch. That wasn't core operations. It was largely driven by revaluation income, about INR 186 million of it.
Currency movements again.
Exactly. Purely the impact of the exchange rate moving in their favor during the quarter. The USD INR rate went from 85.79 at the end of Q1 to 88.84 at the end of Q2. That appreciating dollar gave the bottom line a nice non-operational bump.
Okay, so that brings us nicely to their actual strategy for dealing with currency risk. The hedging. You said this tells us a lot about how management sees the future.
It really does. They're not just mitigating risk, they're making a pretty significant financial bet with their hedging program.
So how does it work? What have they done?
Okay, so hedging basically means locking in a future exchange rate today so you know exactly what rate you'll get for your foreign income down the line. They have total outstanding hedges of $249.3 million. And importantly, these are all 100% forward contracts.
And they've locked them in at an average rate of...
INR 88.04 per dollar on average across that whole amount.
But the really interesting part is how far out they've locked these rates in, right?
Exactly. This isn't just hedging for the next quarter or two. Their forward contracts extend all the way out to Q2 of fiscal year 2028. That's nearly 3 years out.
3 years. And what happens to the locked-in rates over that time?
They climb steadily higher. The contracts peak out in FY28 Q2 at a locked-in rate of INR 92.04 per dollar.
92. So they're locking in today a rate of 92 rupees to the dollar for income they expect to receive almost 3 years from now.
Precisely. It's a very clear, very long-term view. Management essentially believes the rupee will continue to weaken against the dollar over the next 3 years. They're locking in what they see as increasingly favorable rates now to guarantee predictability for their revenue stream.
So they're prioritizing certainty, predictability of cash flow over the, let's face it, probably unlikely chance the rupee suddenly strengthens significantly.
That seems to be exactly the calculation. It's an aggressive stance, locking things in that far out at those kinds of rates. It shows a lot of confidence, not just in their business, but also in their economic forecasting.
And you tie that long-term hedging, that bet on a weaker rupee, together with that massive INR 300 core buyback.
Yes. The buyback uses that predictable future cash flow. It says, "We think our stock is cheap. We're confident in our future earnings thanks partly to these hedges, and we think the best use of this cash right now is returning it to shareholders by buying back our own shares rather than, say, a huge acquisition."
Okay, so let's pull this all together. What's the key takeaway for you, the listener, from this deep dive into eClerx's Q2?
I think it boils down to this. eClerx's had a really strong quarter. Robust revenue growth, yes, but crucially, that growth seems to be strategically driven by success with those emerging newer clients. That's important.
And then the efficiency.
And then phenomenal operational efficiency. That nearly 4 percentage point jump in EBITDA margin quarter on quarter. That's the standout metric. It flowed right down to impressive net profit growth.
Capped off by that big statement of confidence, the buyback.
Exactly. The INR 300 core buyback signals financial health, confidence in the future, and a belief that the stock is undervalued. So, healthy company executing really well.
Okay. That leaves us with our final provocative thought for you to chew on. We saw that North American revenue concentration creeping up to 80%, and we saw that incredibly detailed long-term hedging strategy, locking in rates up to INR 92.04 out to mid-2028.
Right. That whole forward plan, the hedging particularly, it's built on a very specific expectation about the future, isn't it? Geopolitical stability, continued U.S. economic strength relative to India, and a fairly predictable path for the USD-INR exchange rate.
So the question is, what are the risks, or maybe the rewards, of embedding such a specific long-term prediction so deeply into your financial planning? They've locked in $249 million worth of future revenue based on this view.
What happens if that view turns out wrong? If the U.S. economy takes an unexpected turn, or if currency markets surprise everyone, Locking in profit is great, but you're also locking in exposure to that specific
It's
forecast.
a bold strategy. Definitely gives you a clear insight into management's perspective on the next 3 years. Something to think about.
Absolutely. It shows how financial decisions are deeply intertwined with strategic forecasting.
Indeed. Well, we'll leave you to ponder those long-term currency implications. That's all the time we have for this deep dive.
Thanks for joining us. We look forward to digging into your next set of documents soon.